All right, and welcome to another episode of View from the Ranch, November edition. Happy Halloween, Brad.
Halloween's over, Greg. It's November time. It's Thanksgiving. It's turkeys. It's Veterans Day.
Did you already put your Christmas lights up?
First, I'd like to give a shout out to my Shutdown beard, which I have been growing since the shutdown began. It's getting pretty outrageous, so I assume by this time next week the shutdown will be over and I can finally shave.
Makes sense.
Yes.
Makes sense.
Yes. Not very professional, but I'm just
your protest?
doing my part to say, get back to work, Congress.
Gotcha. Well, I'm sure they're listening to you.
Yes, they are.
So good. So no Christmas lights then, I take it, yet?
Not yet.
Not yet. Okay. All right. Well, we can at least get into the markets, and today we're going to talk about the stock market. We're going to wrap up what happened in October. Some excellent calls, though. I mean, everybody was worried that the shutdown was going to affect more than just your beard.
Yes.
With the stock market, but you told everybody, hey, this is a non-event, and you were proven right. Once again,
I know.
You know, you're on a roll
Trust
here.
the beard.
You're right. Trust the beard. That's a good investment strategy, I think, that everybody could implement going forward. So let's just get into October. So it was a good month. Again, you had a lot of technical indicators that were pointing to a good market, coming off a strong September, and we are now entering that very bullish part of the year. And so, despite all the headlines and tariff talk, you had said stay bullish, and you were right. The S&P was up 2.4%, and the sixth straight monthly gain.
Yeah, I think the one word that sums up October would be resilient. We dealt with a couple intraday tweets from President Trump, especially on October 10th, concerning China that sent us down rather hard. And we dealt with some questionable balance sheets at small regional banks and calling into some concern of overextension of loans that are not performing up to standard. Yet we were able to work past those issues and put in another positive month, mostly across the board. The New York Stock Exchange was about even, but the S&P, the NASDAQ, and even the Russell continues to attempt to outperform. It was very strong again this month. We really would like to see those small caps, take the lead for once.
Mm-hmm.
6 months in a row doesn't happen very often. We're getting kind of in that extended territory, but November has been the most, the best performing months really for the last 70 plus years since 1950. It even does very well in the post-election year that we're in. Normally when the market's this strong going into November ends up usually being strong itself. Mm-hmm. Anything can happen, but November and, it's surprisingly, but November and July have been the best months for the market over the last 2 decades. But November has been a constant throughout. So we should expect things to remain relatively positive for the month. I will say there are some concerning points that are popping up, such as, how narrow the market has gotten. We did see relative strength for most equities pull back during the month of October, yet the big names continue to lead us, and they can continue to lead us through some difficult times. Maybe the shutdown has an effect on some of these companies. I don't know. But just a narrowing of the market is a slight negative. All in all, though, we can't knock the performance.
And tech seems to be leading the market. And I just recently read, although I'd known it was a big part of the S&P, that the Mag 7, the top tech names, are about 38% of the S&P. So if you don't own the Mag 7, you're underperforming.
Yeah,
is really what it comes down to. Because dividend stocks, value stocks, all that have just been trailing. So it's a very concentrated group of leaders that are pulling the overall broad indexes up, because they're almost half of the index now. It's kind of, does that cause you concern?
Well, normally good things don't happen when the market gets that concentrated, mm-hmm. But until we start seeing indications that that's a problem, there's no reason to stop believing that that trend's not going to continue. On the other side, there are some, long-term blue chip, high quality names that are just have been left for dead that are starting to begin to look a little bit interesting based on their priced earnings and based on what they're paying as a dividend yield. But for now, the leadership remains tech. The banks that were leading before have weakened a little bit, but the issue that does concern about tech simply is the amount of spending that's going on. And we had earnings last week from some of the big boys. Most of them did pretty well. The one name that did slip was Meta or Facebook. They're going full scale into AI infrastructure, cloud computing, and they're spending, all these companies are spending 4 times what they did 4 or 5 years ago. Mm-hmm. So a company like Meta is getting hit because their spending has not really been monetized yet. Whereas if you look at Google, you look at Microsoft, you look at Amazon, through their cloud business and a lot of their AI build outs that have occurred, even though they're spending a lot more money, they're also starting to see monetization of the previous spending, which lets people know, hey, this is a lot of money getting spent, but we're seeing some returns. Now, in the long run, it's going to be, are those returns really going to support the amount of spending right now? So it's an arms race to see who can get, the bulk of the market right now. And
does it concern you when Meta starts spending? Because how does it bring flashbacks of when they went all in on the metaverse? And
well, if you go back to the tech bubble and you look at some of the names that were flying during the tech bubble, they didn't have any fundamentals. Meta's got a very strong balance sheet. The one issue is that their free cash flow keeps getting compressed because of this spending. So whereas their free cash flow may have been, let's say $71 billion. Now with all this spending, it's now down to 20. So it kind of takes away an area of a protection for them. So, if their free cash flow gets compressed too much, they'd have to start out offering debt. We've seen these numbers compress with the other companies as well because of the massive amount of spending. But when you look at Microsoft and how well their cloud business is doing, it could be doing a lot better if they could build out the capacity fast enough. Mm-hmm. A lot of these companies like Google and Amazon, Amazon Web Services bounced back this quarter. Again, more capacity, they could be doing more. Mm-hmm. So there's a need for a lot of this stuff. It just depends at what point is it going to become too much spending for the street.
And it's like, can they keep up? I read an article on Microsoft and that's the thing that's really been driving a lot of the market and any stocks that's been going up here is this, the infrastructure spending. That's everybody's talking about it. It's applications, AI powered devices, software, data centers, infrastructure, chips, land, electricity, and these data centers are using more and more of the electricity, which is causing our electric bills to go up. I was just in North Dakota not too long ago, and they're building this huge data center there in the middle of nowhere. These data centers are popping up everywhere, but it seems like it's hard. There's not enough capacity, and there's a lot of money that has to go in up front to build these things out. A lot of upfront cost of borrowings higher these days. So it's a lot of money being spent that hopefully and likely will turn into profits in the future, but it's a big expense going forward. But
and the main difference is it's not an unknown like the tech bubble was, mm-hmm. because nobody knew what the next step was with the internet when it was started to gain a lot of traction. So there are benefits here. Some of the companies are extremely overvalued. And I'm talking about the entire atmosphere, whether you're dealing with the big name stocks, like NVIDIA with the chips, or you're dealing with some of these smaller companies that help produce nuclear energy that don't have a product yet, but are trading at massive valuations. Some of these valuations are going to begin to get stretched on companies that can't show any form of support as far as their fundamentals go. But it's also reviving a lot of old name companies too that have been around, like a Cisco, or we've seen, Micron do very well this year. AMD has come back to life. So there's a lot of benefits there. It's just a matter of how much spending is going to be too much for Wall Street.
Yeah. It's priced for perfection, like without any slowdowns or anything. And so I think long term, but definitely if the market turns, if the economy turns, you just going to have to hold your nose and expect volatility, which is always a package deal with long-term investing. If you want to be part of this next decade run of AI, then you're just going to have to expect that there's going to be times when your stocks could be down 40-50%, but then they could come back, and it's that spending doesn't seem to be slowing down. So a lot of people are looking at, well, what are the waves of Microsoft and all these companies, Google and Amazon, spending all this money? Who's going to benefit the most? And it's kind of like the old gold rush. You can look at the picks and shovels and see who are those people, the cooling systems for these AI centers, and even just some backdoor plays of electric utility companies that are going to be generating power for them. So everybody's really excited about it, and the market will always tend to get ahead of itself. But right now the trend is your friend, and there's really no need to fight it at this point.
And we have to be somewhat thankful, because without all this spending, I think the economy right now would be in a different position.
Yeah.
Not saying the spending is going to be good long term if AI gets out of control and starts taking away jobs that we desperately need. But over the last 2 years, this spending has supported the economy. So hopefully we can allow that spending to be kind of a conduit to get us to a position where the rest of the companies inside of the that make up the market, that make up the economy, can start to improve on some of their numbers as well, and start to do the heavy lifting versus the large tech and AI spending driving everything.
But we are seeing some layoffs in big tech and Amazon and some of these big corporations. Is that from AI?
No, I think it's just efficiency. From what I've read, there's certain areas of companies that services and products are no longer relevant. So these people are getting laid off. If we look at the big tech names, I mean, some of their issues on their earnings was operational expenses and the amount of people that they have had to hire. So there's certain areas that may get let go, but in bulk, these companies are still hiring a much larger amount of people than most companies out there. And, I think we're far enough along in the economic cycle that we should expect to see overall some weakening of unemployment data. The problem is with the shutdown, we don't have any data to go by. I mean, our weekly investment meetings that we have and the fundamental or the economic releases that we look for each week haven't been there. Just as, some of the stuff that we work at with the commitment of traders data, it's not there. So some of what's going on is flying, a little blind in the dark. But as soon as the market gets, the shutdown's over with, we'll get all this data dumped back on top of us.
But we can see the JOLTS report, the job openings, and that seems to be just continuing to crater.
Yeah,
it's hard to find a job. I'd say it's kind of like there's not huge layoffs, although you're starting to see some headlines for that. But the job market is still pretty tough if you're out there trying to find a job at this point.
I will say with the economy, we just need to get through the next couple of months. Let's get through tax season, and these companies are going to start to see what types of benefits they're going to get from the new tax laws, and it will make them feel a little bit more secure about what's going on. We look at the Fed, which we haven't spoken about. Last week, they lowered rates again, which they still, from our 2-year yield standpoint, they still could do another 50 basis points and get us in line. The market kind of reacted, the bond market and the stock market kind of reacted a little bit negatively because, they said that a cut in December is not fully on the table just yet, which a lot of the data that we're not seeing will help justify whether that occurs or not. They also are going to stop their quantitative tightening program, which is beneficial as well, because that acts as a liquidity pool from the market. So in December, they'll be stopping their quantitative tightening that's been going on since the middle of 2022, and will begin reinvesting maturities that come due back into short-term treasury bills to help lower the short-term borrowing costs and kind of get the yield curve back to normal.
Okay. And we're starting to see that affect like mortgages. I think the latest was on a 30-year 6.18% and 6.17, down from 7% not too long ago. And then if you went to like a 15-year mortgage, which is a lot of times a good idea, then you're in the fives. But we are seeing a lot more people go the variable rate route now.
Yeah, banks are the mortgage companies and the banks are willing to take chances. So they're willing to say, hey, we'll give you a special rate on the variable side for a certain period of time, with the belief that when that rate resets, then mortgage rates are going to be lower.
You're starting to see a little bit more activity in the housing markets in our area. I know it was pretty dead all summer.
Yeah.
No other hurricanes had an effect with that being in Florida, but you are starting to see a little bit more movement, which is always good.
One of the issues I will say that some people have brought up is that on this quantitative tightening, they were what the Fed would do each month, or the Treasury would do each month, is allow a certain number of their Treasury bonds and their mortgage-backed securities that were on their balance sheet to just, mature. And then instead of reinvesting those assets back into the balance sheet, they would then take them to the market and let the street buy them up. Now, when these bonds mature, both the Treasury and the mortgage-backed securities are not going to get reinvested back in the mortgage-backed securities. They're going to be reinvested back into short-term Treasuries. So some people say, that's probably an issue for mortgage-backed securities, which may have an effect on mortgage rates. It's not a big deal. It's not the case that we have seen mortgage rates expand in the future when we weren't dealing with a type of situation like this. So the main thing is that they can get those borrowing costs lower on the shorter term borrowing costs to allow us to afford more liquidity within the market. And I think as those shorter term yields come down, you'll eventually start to see mortgage rates continue to pull back even further.
Okay.
And the banks are in a better situation now, I think, to be able to offer special rates. So,
and I think we should review tariffs. That's been a big thing all year. You don't hear as much anymore. There was a good headline in the Wall Street Journal about how the U.S. economy has defied doomsday predictions on tariffs. So what's your take on what's been happening there?
It's always, as we know with President Trump, it's always, you come out with the worst case scenario right away, then you work backwards. It's not very fun to go through. It's not fun when the market's getting killed like it was in April for those few days, but it's how it's done at this point in time. We have not seen, granted, we don't have all the data because of the shutdown, but we have not seen prices getting passed on to consumers yet. I don't think that that's going to be the case going forward as well. You look at Apple last week and they talk about the cost of tariffs because a lot of these companies are eating the costs. But even so, most of these companies have expected as tariff expenses each quarter have continued to come in less and less and less. So
there's loopholes, I guess.
There's a lot of games that are played, but the idea of these massive tariffs being placed on different countries always gets rectified and they eventually come down. Now, there should be a small amount that does eventually get passed on, but it's going to be nowhere near the fear that we had, in April, beginning of April, when everybody thought the world was going to end. So far, we're working good deals with most countries. China is the real big concern. It worked an agreement last week to put a 1-year moratorium on certain aspects of the rare earth deal, as well as the U.S. giving up stuff on our end, and we'll work on the framework of a collective deal. So as long as they're talking, everything's going to be fine. We just don't want to have a major issue with a trade war that comes up with China. I think we can handle any other country, but just because of how much business is done in and out of China for both them and for us, we need to make sure that relationship is, positioned as best as possible. But I don't see tariffs really being an issue. And the Fed keeps walking them down, and the Fed will say there's inflation issues, but they'll keep walking down the tariff issues and say that if we do see tariff issues, they're going to be one-off. At this point in time, I don't know what to expect from anything they talk about inflation.
Well, let's focus on inflation. So the latest numbers, it was coming in around 3%, which was a little bit better than I think what the consensus was, but still not at the Fed's 2% rate. Although it seems to me like when I started earlier in my career, everything that when we did forecasting, inflation was at 3%. So it's not terrible to come in at 3%. I mean, versus 6 or 7 or 9% where we were before. And some of the biggest things that got increased were like beef prices and some retail, but over like the housing market, rents have been coming down. So there's a lot of like things that some of the bigger expenses, like especially if people rent, that's going to be a significant savings for people. But so the Fed has a little room there, and that's what you keep saying, that maybe they should drop it a little bit more.
Well, I do think they need to get the Fed rate back in line with the 2-year.
Mm-hmm.
You know, the 2-year tells you where they should be. If the 2-year goes up, then I guess we got to raise rates at some point in time. The issue with inflation is everything I've looked at outside, and I've said it before, outside of a major price increase in oil and a major, country war, we've really not ever seen much in the way of explosive inflation. We saw it in 2022. What happened? We saw the price of oil take off, and we had a major war that broke out in Ukraine, between Ukraine and Russia, which pulled in a bunch of European countries as well as ourselves to help back Ukraine. I don't think that was as much of an issue as the price of oil. Right now, the price of oil has remained relatively steady, and we're expecting OPEC Plus to bring more supply on the market, which would put downward pressure on prices as well. So you may see some things that might get you a little irritated, like whether it's beef.
Steaks are expensive.
Yeah, eventually supply and demand is going to start to take over, and things will begin to even themselves out. Not saying prices will ever go back, because they never always go back to where they were unless we have a 2008. But you'll start to see things come down simply from supply and demand. And I think you've started to see that in cars now. I mean, cars still are up on the higher end, but if you look at the commercials, you're starting to see a lot more money back offerings, as well as close to 0% financing. So the car companies are starting to realize, okay, we can't live freely off of all the money that's out there. Now we got to start enticing the consumer to come back to us. So
what sector was had one of the highest increases in costs? Your landscaper. Landscape, but I think that's more a result of the foreign immigration policy that starting to cause prices to go. So you better start mowing your own lawn, Brad.
Once we see the unemployment data, we'll see again how much natural born citizens have rejoined the workforce, because over the last 4 years, it was rather strange how all the job growth came mostly from foreigners. So things are starting to get evened out there. The shutdown is going to show up bring to light some different issues like SNAP that need to get adjusted. But we just can't keep going on throwing money into the economy like we had been since COVID, for the most part. It's time that things start to get back to normal, and that includes inflation. I think the Fed's 2% rate is a little outlandish. That might have been the case for the last 15 years coming out of the great financial crisis, but historically, like you said, it's not really something that's sustainable.
Yeah. All right. So as we go into November, as we film this, we're still in a government shutdown, although you think that we're pretty close. I guess the big issue is a lot of Democrats are holding out to about Obamacare and trying to get some.
I said this last month. The big issue with that, and I can understand, and something the Affordable Care Act needs to get fixed, but we've never had a continuing resolution passed to fund the government with a sizable spending bill attached to it, which is the continuation of the Affordable Care Act subsidies from the COVID period. So what should happen is the CR should be approved under the idea that there will be a somewhat of an extension of these benefits for a period of time for an agreement to come to place, or the belief that they can get something worked out in a period of a month. There's no reason why a clean continuing resolution should still be sitting there, just from a historical fact of not attaching massive spending bills to it. So, but it's ugly. It's all ugly. I think it will get, I think the shutdown will be over this week. I think after we get through the certain mayor and governor elections on Tuesday, things will open back up.
Okay. All right. So going to November, what's your call this time?
Well, we've seen some things get a little weaker. The market's gotten narrow. That needs to get corrected rather soon. So once that does, I think we're good to go. Now, if it doesn't and it keeps going this way where the market keeps getting narrow, obviously we're going to think that there's some weakness that's going to be coming. Would be out of the norm for November. One thing I'm keeping my eye on, and this is a little far out there, is just the relationship of the dollar to the yen. There was a election in Japan last month. They elected a new prime minister she's very conservative, monetarily responsible, under the same idea as Prime Minister Abe that was sadly assassinated a couple years ago. Very market friendly. So we've seen the dollar strengthen against the yen. Mm-hmm. And if that can occur, we'll see kind of a rebuilding, not saying it's a good thing, but we'll see a rebuilding of the yen carry trade, because people will be able to borrow money in yen much cheaper, and then exchange those into other dollars and inflate assets throughout the world. So if the dollar can continue to strengthen against the yen, I think you'll start to see a little bit extra juice come back into the market. Right now, I think a lot of the weakness that we're seeing now maybe is an issue with the shutdown and not knowing what the data is, being concerned what are we going to see on inflation, what are we going to see on PPI, where's unemployment going to be. But once that comes out, I think everything should start to broaden out, because there's a lot of value out there at this point in time. Mm-hmm. And then we work into December, which December again should be a good month. And then we're at the end of the year. And then we'll talk about 2026, because it's the second year of the election cycle, which traditionally is a weaker period for the market.
Okay.
But for now, we should still be able to see the strength that we have. We just need to get a little bit more participation.
Okay. All right. Well, that's it for the November edition. Stay tuned for December. If anything changes, we will update you. And thanks for tuning in, and God bless.